Hi, everyone, and welcome back to another show. My name is Tyler, and I'm here with Matt, the founder of ORATS. ORATS is an options analytics platform built on top of over 15 years of historical options data. Our dashboard is integrated with Tradier, meaning you can research and discover trades on our platform and then seamlessly connect them to your Tradier brokerage account. Today on the show, we're going to show our latest beta dashboard and discuss how to reduce overfitting and path dependency in backtesting. Matt, do you want to share a screen and get us started?
Sure. So overfitting and path dependency. So what we want to find is a backtest that looks good in the backtest, but that also will continue to perform in the future. And so what you want to make sure is that what you're optimizing has some predictive capabilities or some alpha going forward. So there are other backtesters out there. We have backtesters, various types. We have a backtest finder, which is a large database. And then we have custom backtesters that you can also run. But the one that we're most excited about, and one that we think presents the best alpha, is using data that we've created over the years. Back when I was a market maker, we started, and we've created quite a few different indicators that we've talked about on this show before, but we'll talk about a little bit more, especially when we see some of these strategies identifying certain indicators. So what I'm doing is I'm looking for backtests that are in the market a fair amount of the time and have some variability that's not just the variability of the stock. So, close to, correlation, high correlation. We want to kind of not so correlated, but we want these movements in the backtest, enough movement so we could apply indicators that hopefully are driving these movements. And then we could come up with something like saying, oh, only trade this when the volatility is rising, or only trade this when the ETF divided by the symbols volatility is between a certain amount. So that's what we're looking for here. So what we do is we get this backtest, and then we click optimize, new button that we've put in here. And this is our new beta version of the backtester. We're looking for beta testers now, and we want to make this as clear, easy to use, and valuable for people. So what we have here is a backtest overlaid on a candlestick graph of the SPY. So, and then what we can do is say, well, this is just the standard 16 DTE iron butterfly with SPY. But what we could do is we could say, okay, let's use some of these calculations and see if they have any predictive power. And we'll talk about an indicator called the p-value. We've researched how to calculate this, and basically what the p-value does is it's a statistical process that calculates the probability of the results that you're getting are because of pure chance. So you want to minimize this. So you want to have, ideally you want p-values less than 10, less than 5, but it's somewhat difficult to do that. So we try to search through our database and find it. So in this case, it's only about kind of a 50-50 shot, 30% here. So this is the p-value column here, and this is what the new result, the average percent per day. By the way, 1/10 of a percent is very good for a day. And then I just know from past experience that some of these, actually this isn't that bad one, so I'll click on this one. So this is a 26 p-value, and what we're seeing is it's only going to trade when the implied volatility percentile to the ETF is within a certain SMA range. And in this case, it's a 20-day period, and we automatically do these for you. When we first developed this, I was key whacking in all this stuff, and it was quite a chore, but Tyler has worked on this to make it to have a lot of automation. And it might seem like it takes a lot of time, but believe me, actually inputting a lot of these, it takes a lot longer. So this one will look for a period when the SMA 20-day is less than the 50-day. And it'll exit when the SMA 20-day is greater than the 50-day. And you can see when these happen, it's denoted by we're in the trade when it's green and we're out of the trade when it's white. And you can see now this third line that we've added is a SPY iron butterfly with signals. The other one is just trading it all the time that came from the back test. But now we've overlaid it with not only the stock price and the old back test, but now this is the new back test with only trading on these signals. And what you want to kind of avoid, are the times when it goes down and you want to do better than when the times that it's going up. Anything on that before we start looking at the stats, Tyler?
Yeah, well, I kind of just want to take a step back and talk about like why we're doing this, right? This is a pretty advanced tool. What's the purpose of using this tool? Kind of, can you go over kind of the journey that we took from key whacking stuff into the legacy backtester 5 years ago to where we are now?
Yeah, and I'll go back even before that. We at ORATS, we developed, a lot of these indicators. They're all kind of listed here. IV to ETF ratios, the forecast divided by the implieds, and we thought that these were good indicators. And then people said, well, how do we know it's a good indicator? They say, well, we do statistical R-squared, which is a regression analysis. And then they go, well, how do I know if it'll work in my trading? Then we say, well, let's simulate what you would do trading and use these indicators to help you get in and get out at only certain times. And so we did that when we came up with a backtester. And then, you were able to develop some good backtests, but you don't know if these backtests could potentially be overfit or have path dependency, which we'll talk about a little bit later, or are they good? And then so we've dug deep and we said, well, what is the best gold star indicator? And that's the p-value that we can use to help us assess these. And the p-value does a lot in the background. It goes through and jumbles up things, and it calculates. It does things to identify whether it's kind of a chance outcome or if these calculations that we have are actually useful in this particular backtest. Some backtests will be more sensitive to some of these than others. So forecasts, long term versus short term. So we have a lot of these technical indicators that we've come up with that might be more important than others. And so you can tell we have many here, and we've sorted them by how much it's helped the backtest and what the p-value is.
Yeah.
Is that what you're looking for, Tyler?
Yeah, that was a good overview. I mean, at the end of the day, the goal is to have a strategy that you can trust in when forward testing it. The issue is that we're still just looking at historical data, so we've had to come up with some very advanced methods to rigorously test the validity of these strategies. It's one thing to sort of key whack backtest in and see how it does, but you're making yourself vulnerable to path dependency and overfitting. And so we've worked hard to reduce those variables in our testing so that this is hopefully the closest that you're going to get to what you can see in the future. Obviously, no one can predict the future, but this is a lot more statistically sound.
Yeah, and then so then what we do is we say, okay, well, we've done this procedure. Now we're going to give you the ability to, paper trade this. So you could, so let's save this. It's a little bit high of a p-value, but you would go back and forth with finding backtests that have, the best p-values. But now, now we save this particular strategy, and we can, go look in our saved optimizers. So this is a saved iron butterfly 16 DTE. You could sort these by various ways. You can sort them by returns. You could sort them by many different things. But this particular one, we've sorted. And then, do you want to explain what this button is, Tyler?
Yeah. So when it lights up green, it means that it's quote like in the trade. So it means that the indicators are saying that, the indicators say it's a go. Any backtest entry triggers that you had say it's a go. And then you basically, you're given the green light to scan for trades on that strategy. And then you can click it and it'll take you to the option scanner, fill in all the information that was in the backtest, sort of the DTE, the strike deltas and stuff like that. And then you can look for trades from there.
Yeah, that's a good, and it's a very handy workflow. It puts it all in for you. You're just kind of going through this, and then so we're finding based on distributions. You could sort these based on different things. Forecast. We like to get rid of any outlier S percentages. I would say like 1% or 2%, but these are only 0.1%. So what that is saying is that the SMV is very close to the SMV is very close to what's in the market, the mid market right here. So a lot of these trades are good trades, and this isn't sorting by the best fit one. You want something around 16 days. So what you might do is you might say, okay, well, I'm going to paper trade this. So my assumption is I could get filled, or you could have a paper trade. The paper trader has a kind of an assumption of fill that has some randomness to it, or you could just say, well, this here's the market. I want to force this trade in. And then I also I could say things about this later on. We can put notes, but we'll talk about that a little bit later. So anyway, that goes in the market, that's filled. And then you could set any exits based on, where the exit might be or whatnot. So that now is tracking that particular trade, and you can essentially forward test the back tested optimized strategy that you had with that forward test. Anything on that, Ted?
Yeah, I mean, that's the full process. Where our goal at ORATS is to make that process for our users the easiest as possible, the most seamless and fastest as possible. So I mean, we're definitely making a lot of strides in that direction. It's great to see this sort of coming full circle, from backtesting, and the backtest finder has 339 million backtests now. So that's over 100 symbols, 15 strategies for each symbol. I mean, very likely you can find something in there, something useful in there.
Right. And then, there are many different strategies that you could look at, short put spread, short strangle. And then, again, you want to find strategies that look like, they're in the market a fair amount, and we can identify, try to find try to find indicators that improve these. So I could say, again, I could just go in and optimize this. And then, like I said, it takes a second to calculate these. We do a lot of these calculations locally as you're pulling it up. So you might hear my computer in the background.
Yeah, so we're testing the short, medium, and long-term simple moving average in both directions. So comparing like the 10-day to the 20-day less than or greater than, the 20-day to the 50-day less than or greater than, and that's what we're doing. And we're comparing the technical indicators on the ORATS indicator. So it's not just technical indicators on the actual stock price. Like we have hundreds of indicators that we're testing.
Right. So this one, 43 isn't that good. So, you would just move on after that. And then you start to see, okay, I could see what backtest might be better or worse for finding these. So I like to be in the market more.
So yeah, let's go over that p-value number again, because it's an important number. So the way we define it, well, it's a term used in statistics to describe the likelihood of an event occurring, assuming the null hypothesis is true. So in this case, our null hypothesis is that the indicator just has a completely random effect on the backtest, right? Like if you're adding an indicator, it's just completely random if it improves it or does not. So when the p-value is less than, let's say the p-value is 0.1. That means that it has a 10% chance of having a random effect on the backtest, which is good, because that means that 9 times out of 10, that's a really strong indicator that isn't random. So you want to look for a p-value that's lower than 0.1. Ideally, the lower the better, really. But again, it's hard. If it was this easy to time the market, then everyone would be doing it. So,
and then you can use multiple indicators too. So, sometimes that helps to lower the p-value, but the p-value has its own way to it's not just going to automatically improve because you have more indicators. It takes that into account, and it has to, everything needs to be truly additive in order for the p-value to go up. So in this case, we had a p-value, and it doesn't look like we're improving it right yet.
You can sort by the p-value, Matt. If you click the column.
Okay.
That's sorting from largest to smallest. So the lowest we're seeing is like 0.4.
Yeah. So anyway, on this one, probably not. But I have some saved optimizers that have some decent p-values to them. Here's a 10% one. Here's a 1% one for XLE.
So that's essentially there's a 1% chance that indicator has a random effect on the backtest to achieve that average percent per day. So I mean, that's pretty good.
Yeah. So some are high, but I still put them in there because they have decent looks to them. I'm just kind of scrolling down and looking at these. Here's another one, DJX, but that's not. I was trying to look for one that's in the market right now that's really low. But I don't see. So the lowest one in the market, there's a 0.9 for solar. 17. There aren't that many in the market right now, which is interesting, because what happens is, especially if you get 2 or 3 of these going, you're going to sometimes you're not going to see you're not going to see this turning green. So what we see here with this one, one of the things I wanted to show you, Tyler, is we haven't talked about this yet, is the original test. No one really looks at the percent per day, but until you start doing this, because that's what these are every day that you're in the trade. What is the percent per day? The margin returns, you're only in the market half the time, but your returns are still higher than the original. So that's good. And then so we try to make it easy, like the green are better than the original. So that's what all these. In this case, how this did in a bullish market was worse. We only made 3%, whereas before it made 6%. But it's better over the last 5 years, better over the last year, and so we put these calculations in to help you look at how the new one compares to the old one.
Yeah, those I love that stats drop down. You can see so many things so concisely right there.
Right. And we have slippage, so we should maybe talk quickly about like how we calculate these, how we apply the indicators, because we're not necessarily going in and redoing the backtest.
Yeah,
we're making some assumptions. So let's just talk about, first of all, the backtest. In order to reduce path dependency, especially 16 DTE is not, it's considered kind of a medium to short term trade, but we have some trades that are longer. If you only traded once every quarter, that might have some path dependency to it. What that means is if the stock has just gone up and so you have this, put spread on, and then the stock tanks, it's not going to affect the put spread that much because it's so far away from it. But if you kept trading these your put spreads, it has more of a normalizing effect, or an effect that you might expect if you actually had the trade on, because it's going to keep the trades closer to what you would put on at the very beginning. So that's the first thing. In order to reduce path dependency, we assume you trade every day. Now, you don't want to do that, if you're trading, but it just helps make the returns match more what you would expect if you're closer to the market. So that's the first thing that we do. Then we get pretty accurate daily returns. And then with the daily returns, that's when we start using the indicators. So we're doing this indicator analysis using daily returns. You might say, well, is that fair? And we think it is fair because we've come up with a method for applying slippage. So we have commission, we have overall spread slippage, we have defaults where you would trade. That I've held up over years of doing it. So like if you have a one leg strategy, you might travel 75% of the bid ask spread to trade. If you have two legs, you're going to have a wider market, so you might only have to travel 66%, and three legs 55. And if you have a four leg condor or something, you don't have to travel 75% usually. The 3% is a pretty good edge for market makers to trade. So we have baked in this slippage into the particular outcomes. And if you take it out, you can see that the results are, a lot better. So clearly slippage is, obviously a pretty big negative. It's not too bad in this strategy because you could see that you're trading in, you're trading out. It's not like trading like some strategies you'll see, a lot of trading around it. And then the slippage is a much more penal, yeah. But in this case, it's not that bad.
Yeah, the slippage definitely. Can you toggle it on and off really fast?
Yeah, I just did. I think it's like, so it's 0.24 is the daily here.
Yeah.
And then, so it's just 0.25, so it's not that much different. You can see how it does improve the p-value as well,
Yeah.
but so it's not too bad in this case.
Yeah, the slippage, we've seen it have a massive effect. It
Yeah.
kind of just depends on the backtest.
Yeah, if you're trading a lot, like I said, like some backtests, you'll see them in and out 4 days. This whole period is 31 days, so so slippage is not going to bother this too much.
Yeah, the slippage, definitely want to make sure you have that turned on. It's turned on by default, but sometimes turning it off is kind of interesting to see the effect it has.
Yeah, and you can see it here. Like, it's important enough so we say, hey, you use slippage on that, so that's good, right?
Yeah. So all these things that we've thought very carefully about how we do. I mean, we've been working on this for a lot of months. So we've thought very carefully about how to make this the most statistically robust implementation of backtesting, and it's magnitudes better than just key whacking in. So we're excited for you guys to use this approach, and we're excited for the whole thing to sort of come together, the end-to-end strategy development with paper trading. So our goal is to just make that a lot more seamless and a lot faster for you guys. We're going to be releasing some curated strategies to go along with the beta, so you guys will be able to sort of hop into some really good quality optimized backtests almost immediately. And yeah, I mean, that's the new tools. Yeah, we're probably going to spend a few episodes diving into various things on this because there's a lot to go over. But yeah, thanks for the overview, Matt.
Yeah, I mean, thanks for all the effort in making this. This is quite an effort. This is where I wanted to get to, when we started ORATS, or actually, that's not true. What happened was I really wanted just to have really good data that you could use to trade with, but then people kind of demanded, well, I want to backtest it before I put it in. And then after that, we said, well, we just, kept the progression going until, this is really the progression of the whole thing that we've done. And we've started with having awesome data and it's starting to be shown off here, because that's the hardest thing. You can make backtesters, but it's really hard to have the good data to have the alpha in it in order to get the p-values up so you can be confident to actually make money trading.
Right, that's the secret sauce, the indicators. Auto is also getting a lot of improvements. So Matt, if you go and click the Ask Auto button.
Yeah, and I also just wanted to show that we also have, a trade journal where you're going to be able to kind of monitor, the strategies that you've tested and all that. So this is all helping with, with that kind of review process. Once you get these, get these back tests going, this is a further test to get further confident in there. And then, you could ask ORATS, like, what's the SPY current implied, price and wolatility? And it now, Auto on our site is very good at talking about our offering and where to get the data and what we do. But this now, Auto now has been trained to go into our data and research much deeper questions on implied volatility levels and current price levels and all that. So there's a lot that Auto can do right now to really give you some more insights into what ORATS data has. And you could ask it some pretty crazy questions, and it goes off and it goes through all our databases, and then comes back and lets you know.
It's a little slow right now. I'm not sure. Yeah, I'll have to, again, beta version of the dashboard. We've improved Auto a lot. It's been a huge hit on the website, so we're putting it into the dashboard now, and it's going to be able to look at all the data and do a lot of things there.
So. No, it's amazing. Like I said, we're just getting into beta versions. We're just inviting what we call friendlies to come in and give us some feedback on all of this, and see how it all works together and get input. And of course, we still have our all of our old research, just in new spots. And then, we have a place to go in and learn. We have our community, we have our blog, and then all of our webinars and instructions here. So, I mean, you could really learn a lot about options on this right now. So it's very cool.
Great, Matt. Yeah, we're just about out of time, but yeah, that was a good introduction to the new dashboard. If you guys want to be a part of it and join the beta, just email us at support@orats.com. And then, yeah, if you guys have any questions, please ask them here on the live webinar or on our web chat. You can ask Otto, you can email us, or you can talk about your questions in the community tab. So lots of places to ask your questions. Yeah, thank you, Matt, for another great show. Thank you, Trader, for hosting us, and we'll be back again next week.
Thanks, sir.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.